So this week we saw a really good pullback in the stock market. Is that going to create the buying opportunity of the year? Should we be buying in whatever it was we've been looking at right now to get ahead of the market and be ready for that next up move? Stick around for today's video. We'll get into that, and I think it should be a great video today.
Want to make your money work harder? Enjoy another video with Adam Kahn, the rational investor, on stocks, real estate, and crypto. Subscribe now for your weekly dose of investment insights and hopefully learn a thing or two.
Hello, my YouTube friends. Happy Saturday. I hope everybody's doing well. My name is Adam Kahn, and this is Investing with Adam K. Previously, the rational investor, for those of you who've been sticking around that long. Hope everybody had a great week. I hope you didn't get beat up in the markets too much. That being said, is this a great time to be buying the market? Well, I don't really think so. Not yet, depending on what your strategy is and what your goals are. Now, like always, this is not financial advice. Please don't listen to me or anybody else on YouTube for that matter. When you make your own financial decisions, you need to do your own research and reach out to your financial planner, because everybody's situation is different than everybody else, and what works for me may not be what works for you. Now, what do I mean by no? As much as I think that this was a good pullback, I watched my last video and I worry that I gave the inclination that you should be buying and getting in and really excited because we finally saw some panic. While I do believe we finally saw some panic, and that's a good thing because I like to see the panic, because you need to wash out all the weak players and the people who aren't really in for the long term, that unfortunately I think this is the beginning of the panic. I think we're going to see some follow through. I think we might have bounces along the way. And unlike COVID, where we saw a really quick drawdown and then it reversed into a V bottom and go right back up, I don't picture this having the same type of scenario. I do think we're going to have a real pullback, but it's not a COVID thing. And even the tariffs that were implemented, I think that's more of a catalyst than anything else. I think what's happened is stock valuations got too high. They're beginning to come in, and the markets are still priced a little bit high for where they should be. And what tends to happen is, as far as they've gone in the too high direction, they're going to come down and go too far in the down direction. I also think the Fed is going to be late to the party, like they typically are, because they don't come in and try to catch the falling knife until the data supports it. And the data is usually late to the party as well. So then the Fed comes in late. But it really is a rinse, lather, repeat type of cycle, which is markets get overheated. They then start to fall. The Fed comes in and cuts rates and injects liquidity, which catches the markets, and they go back up. But that takes a long time typically for it to happen. And unlike COVID, where they just injected people and gave them free money and forgiveness and everything else, that isn't likely to be what happens currently. People are able to work. There's nothing about stay at home. So we'll probably see unemployment spike up as things slow down, which is what I think the tariffs are going to end up doing. I don't think we're going to see the inflation that people expect, because people are already stretched thin because, like I've said in many videos, we all hate the inflation. We still get sticker shock. I'm not sure how much more room there is to go to be able to raise prices and continue to drive earnings. And if the tariffs are going to raise prices, what I think you're going to see is a global trade slowdown, economy slowdown, earnings begin to drop a bit, and an actual slowdown occur. Now, the one good thing is, for those of you who've been complaining that prices of homes are too expensive and mortgage rates are too high, if this is sustained and you see the stock market continue to go lower and things begin to slow, what you'll see is house prices soon to follow. They'll come down as well as rates. They'll become quote unquote more affordable. But hopefully by the time they're becoming more affordable, you're still in a good position where your credit's still good, your income's still good, you haven't lost a job, and you're not too scared of the market that's correcting, because it does get nerve-wracking to buy it into a market that's falling lower. Now, I always say this, and I really mean this. If you're looking for a house as your primary residence and you overpay for that, but you're able to afford it and prices of homes come down, I personally think that's okay. If you're in a situation where you plan to live in a certain area for a long time and you don't want to deal with a landlord or run the risk of needing to move because of factors that you can't control, and you don't love being a renter, I wouldn't look at buying your primary residence as an investment the same way I'd look at an investment property. Sure, it's nice to look on Zillow or wherever you might look and see that the price looks like it's going higher. But in all reality, if you can afford the monthly payments, you can afford the maintenance of the house, and you really like the house, there's utility out of that that you get that you don't get from buying into other things. So it's okay if the prices go down. But to be fair to the doom and gloomers who've been complaining for the past 4 years and we're just super early, I think they're probably going to get the correction they've been talking about. Now, I am wrong a lot, which is why I give that disclaimer. And I really don't want anybody making their decisions based on what I say. But I think that the tariffs coming in and the fall of the stock market is just the beginning of what we're going to see. And I hate to be one of those doom and gloomers because I'm actually not doom and gloom. I just think that's the cycle. It's like a rinse, lather, repeat. We go from too inexpensive. And as I cut myself off, if we think back to when Jerome Powell first talked about what we were getting into and what he saw coming and what he thought the Fed would end up having to do, he made a comment about things have to break. Like you don't have a boom cycle after a boom cycle, and you need the bust to come in order to rebuild and have the next boom cycle. Since we didn't get that, I think that the new administration is going to end up getting the blame for it because I do think this is probably what's going on right now. Now, in terms of investing, if you have a good job, I would continue to go about things the way that you have been. I'd continue to invest and I wouldn't pay a whole lot of attention to it. If you are a trader and you watch the markets, I would be careful about consistently trying to pick a bottom because I think we're going to have some time. I think you're going to see it take a little while to wind out because there's still a lot of fluff out there and there's still a lot of extra money. I didn't want my last video where, in the last few to be fair, where I keep saying I'm buying this and I'm buying that, which I really am, but I'm doing my best to hold on to the bulk of the money that I put on the sidelines to wait until I see a real flush out and see some real bargains. There are still companies out there that I think are really well valued right now, and I'm trying to be careful about overbuying Amazon and Google and Meta that I really love. And as I've said, those are in my trading account. In the trading account, I have gotten out of most of those, and I'm more looking at Target and Whirlpool and Archer Daniels Midland and even Black and Decker, Stanley Black and Decker, that I've recently started looking at. What I like about the first three, Target, Whirlpool, and Verizon, I started looking at. What I really like about Target, Whirlpool, ADM, and Verizon is their payout ratio to the dividend. Now, Whirlpool's, if you look it up, looks like it's really bad, but I don't think that's actually the case. I think they took a one-time expense that made the earnings look bad so that it looks like they can't cover the dividend. But when I look at Target, for example, they're making over $8 a share. The price to earnings ratio is about 12 or something like that, which is super low for what their growth rate was expected to be. But what I really like about the stock is they're only using 50% of their cash flow to be able to pay the dividend. So even if there's a slowdown, there's a lot of room for there and error for them to be able to continue to pay that dividend. And if we have a slowdown, you're going to see bond rates drop. So you're not going to get the 4% that you've been getting the past few years. That should drop down into the twos or potentially the threes. And now I'm looking at a stock that I can get over 4% dividend that I think has a potential to grow in stock value, even if it goes down in the short run. I'd rather take the higher interest rate, accept those payments over the next few years, while I hope the economy catches itself and we don't have huge unemployment, but I think I'm going to get a better yield than by being in a bond, and I have Target as the underlying equity that could actually go up in value. When I looked at ADM, it was pretty similar too, where they're only using about 50 or 60% of their cash flow to be able to pay their dividend, which is now pushing above 4% as well. Then I looked at Verizon and I was thrilled, who's paying over 6%, and they're using only 60% of their cash flow to be able to pay that. That's pretty strong. That means they could handle a slowdown as well and still be able to pay that dividend pretty easily, and they're paying over 6% yield, which is phenomenal. Now, I think if the economy slows and they're able to continue to do that, you will get stock appreciation simply because that yield is so good. And that's where I come in with Whirlpool too. Same thing, and they're paying an 8% dividend right now. My only concern is that it ends up not being a one time expense. And since they're limited to just, I don't want to say washers and dryers because they own a bunch of companies and they do a lot of kitchen appliances and things like that, but they're a little limited. So I worry that they have a bigger slowdown and maybe they aren't able to pay that dividend, but at least for now they are. And that's a super high dividend. And then I'm avoiding all the tech stuff because what I'm worried about is we might have an AI bubble like we did an internet bubble. And I think it got out of control on some things and the valuations became unrealistic. If it ends up that the AI isn't going to change the world quite like we thought, and it takes longer than we thought, which is generally the cycle that we go through because that's as humans what we tend to do, it'll be really interesting about the capex and how much these companies are spending on something that may not really change the world the way that they thought it would. Do they cut that spending? Is it really something that can drive the revenues? Like what ends up happening with the AI and how we're going? And does it really change the world the way we expected as fast as we expected? And then the problem is, if it does, what happens to a lot of job displacement? Because I don't see new jobs being created from the new technology. Unlike when the car came around and replaced the horse and buggy, and we had that new technology, and you saw the horse and buggy places start to close up as the auto plants opened up and people had to build the cars and sell them and whatever else. The goal of the AI is to get rid of humans. The goal of things like automobiles and television and phones and things like that, the technology advancement, the goal was not getting rid of humans. It was just making us more advanced so we can do things quicker. But it didn't really mean the end of us at our jobs. When you look at the new technology, I mean, go into a McDonald's and look at what happens. I said to a friend of mine, there's one not too far from where my old restaurant used to be that I stopped in to get a burger because whatever, I shouldn't be eating McDonald's, so I'm sorry I admit that. Anyway, I stopped in. They didn't even have somebody behind the cash register. Now, I watched somebody walk over to the cash register, and maybe 5 minutes later, somebody noticed them and walked up and took their order. But they've really shifted gears where you order for yourself. There's only 2 or 3 employees in the back that make the food. So you put your order in and they make it and put it on the counter, and that's it. So they've gotten rid of a lot of employees as the technology has changed. I think that's also what makes it harder for some of these mom and pop places to compete with the bigger companies because they're able to autonomize. Is that the right word? And maybe not. But they're able to automate. And even though it's a big upfront expense, they're getting rid of the employees. They don't have to worry about the healthcare. I'm not sure. I'd have to research it again. But I remember watching about a McDonald's that had opened up that had no employees. Now it was drive through only, but they were open 23 hours a day because they had to shut down, if I remember correctly. They had to shut down for an hour so the machines could reboot and whatever else. But everything is done by machines. And then it automatically lets the corporation know what they've sold so they know what to deliver. And then it's all run by machines. If you order whatever you order, the machines make it, send it out. It opens the door up to come out in the dispenser for the drive-through. You get your food and off you go on your way. Not one employee is there. I think when they make the deliveries, they put them where they're supposed to do, but somehow it's able to heat your food up, send it out the door, and off you go. I think there are other restaurants opening like that as well. So, will we see higher unemployment? At the same time, we see some slowdown. At the same time, we see prices start to come down, which in the long run is just fine, which is why I'm not gloom and doom. And I also think there'll be some opportunity depending on what you do. But I want to be prepared for a pullback. I don't want to just assume the markets are going to catch themselves and go straight up, while I also stay invested through it. I mean, I'm not really Warren Buffett where I'm comfortable just selling because I see it being overpriced and sitting on the sidelines and waiting it out. but I don't mind shifting into things that are a little bit safer that'll pay some dividends while we go through the transition and making sure I'm well diversified. I hope you guys are as well. Let me know in the comments. Are you well spread out? Are you ready for a big correction? Or do you just think we're going to catch ourselves? Because everybody's opinion is correct. There's nothing wrong with different opinions. I'm just curious what you guys think. And part of why I think that is I've thought for a long time the people who talk about the housing, like, they're not wrong that it's overpriced, and they're not wrong that the rates are too high. And eventually things tend to work themselves out. But when it does, be prepared that there should be some opportunity on the other side. Like, there should be a point where rentals, in my mind, make sense again, that you're able to buy the property inexpensive enough that you can put down 20% and make more on the rent than your mortgage payment and have a cash flow coming in while potentially the property increases in value as well. And then in time, hopefully I'm still alive to see the next one. We'll have another boom and then we'll have a bust. And like, that's what's always the same, and nothing to get overworked up about, but be prepared for the cycles to continue and continue and continue. Now, I would be careful of the Palantir type companies, just my advice. Again, do your own research, but I'd be very careful. If you look back to the internet bubble and what happened to the NASDAQ, it dropped 90%. Not 9, 90. I mean, that is insane. And it just kept going and going and going, and it took a lot of time. Why? Because a lot of companies that really didn't have earnings were so overpriced that all of that fluff had to come out. And a lot of those companies never even ended up having earnings. So, by all means, there are some great opportunities out there already. There are companies that have good earnings that are fairly priced, but there are also companies that just got so overvalued that how far they probably have to come in to get undervalued before they catch themselves is probably a long ways away, despite where they are today. Despite whatever you think their price to earnings are currently, I would be careful of something like an nvda, which is a company I love, so I don't want it heard the wrong way. But what I do worry about is if we have a slowdown, that the big companies like the Amazons and the Metas and the Googles may end up slowing down how many of those processor chips they need to buy, and you won't see them being able to get 80% of uh, profits on selling them, because now they'll be able to make enough of them that they just won't be able to get those margins because they can keep up with demand. Like, things may change, and it may be different than it is now. And if the margins come in and if the demand doesn't really increase a ton and their earnings start to slow a bit, well, then they're overpriced, even though the forward PE for what it was making currently is really attractive right now. That can change. Not saying it will. In fact, in the comment section, tell me what an idiot I am, and like, I'm fine if you tell me how stupid that is and it's the best deal ever. I'm happy to have the discussion. But what I think is going on and why I think you're seeing the prices come down is not just the tariffs. I think it's that there was a lot of fluff out there. Anyway, do me a favor before I forget. Give me a thumbs up. Hit that subscribe button if you haven't already. Make some comments in the comment section. I really appreciate it. It helps YouTube's algorithm, which you all know. If you've made it to the end, I love when people say, hey, I watched to the end. That's super cool. I'll probably post the chicken dance from Miracle League today, because Saturday is our Miracle League where my wife, my son, and I all go out and coach, and it's super cool. If you're not familiar with it, look it up or find something. It feels really good to go out and help a little bit and volunteer some time. Um, but I'll probably post the chicken dance between innings, which is, anyway. Have a great weekend. We'll see if I get to talk to you guys tomorrow. Let me know what you think of the markets, and enjoy your day. Bye bye.